Imagine waking up tomorrow morning, checking your ledger, and realizing you just inherited a working gold mine. Maybe it is a sprawling open pit tucked into the desolate hills of Nevada. Maybe it is a subterranean shaft in Ontario. Or perhaps it is a high-grade discovery in Western Australia that a cash-strapped junior exploration company had to abandon because they ran out of runway. Either way, the metal is down there. Thousands of feet beneath solid granite, millions of ounces of pure physical wealth are locked away in the Earth's crust, and the macro backdrop could not possibly look more perfect. Spot gold prices are screaming past $4,000 per ounce, hovering near the highest level in human history. Wall Street analysts on CNBC are calling for $6,000 gold by the end of the year. You pull out a notepad, multiply 3 million ounces of proven reserves by $4,000, and arrive at a staggering headline number, $12 billion. You assume you have just unlocked the ultimate financial cheat code. You think you own an inflation-proof central bank-resistant cash machine that will print free money for the next 3 decades. Here is the brutal truth that every veteran mining executive learns the hard way. You do not own $12 billion. In fact, you might be holding the fastest asset-backed vehicle for financial ruin that capital markets have ever invented. Across global commodities history, operations sitting on billions of dollars in underground gold have dragged their corporate parent companies directly into Chapter 11 bankruptcy. Meanwhile, unpretentious operations producing a modest 200,000 ounces a year quietly generate more liquid free cash flow than half the companies listed on the S&P 500. The difference between those two outcomes is not luck, and it is not geological fate. It is unit economics. The business of extracting precious metals from the earth behaves almost nothing like what retail investors imagine from the outside. You are not hunting for buried treasure chests. You are operating a hyper-leveraged, capital-intensive manufacturing facility that blasts, hauls, crushes, and chemically cooks millions of tons of solid rock just to collect a handful of invisible specks. Welcome to the World Money Desk. Let us tear down the balance sheet of a gold mine, piece by piece, the way an operator actually sees it. Before you spend your first dollar, you must understand what gold in the ground actually is. It is not liquid money. It is not even raw gold bullion. It is an elemental anomaly distributed across billions of tons of solid rock at concentrations so microscopic that you could wander through a cavern with a microscope for 20 years and never see a single shimmering flake. Gold mines do not mine gold, they mine ore. Ore is defined as rock that contains enough metal to make extraction economically viable. In the gold sector, concentration is not measured in percentages. It is not measured in pounds per ton or kilograms per ton. It is measured in grams per metric ton. To extract a single troy ounce of gold, a coin-sized piece of metal weighing 31.1 grams, a typical open-pit gold mine must detonate, haul, crush, grind, and chemically process anywhere from 30 to 300 tons of solid rock. That concentration ratio is called the ore grade. It is the single most critical variable in mining finance. It dictates whether your asset is a license to print money or a black hole for capital. If your deposit sits at a grade of 1 gram per ton, you are operating on razor-thin operational margins. Every spike in diesel or labor threatens your cash flow. If your grade is 3 grams per ton, your mine is performing solidly. If you hit 8 grams per ton, you are holding a premier high-margin asset. And if you discover 30 grams per ton, you have uncovered a once-in-a-generation geological miracle that can transform a junior penny stock into a multi-billion-dollar mining titan overnight. Look at what happened in Victoria, Australia, at the Fosterville mine back in 2015. Geologists struck an underground zone that averaged over 44 grams of gold per ton of rock. That single discovery was so absurdly rich that it crushed Fosterville's production cost down below $400 per ounce, at a time when gold was trading near $1,200. It transformed a marginal, struggling asset into one of the most profitable gold mines on planet Earth. But Fosterville is the extreme anomaly. The vast majority of global gold production comes from low-grade deposits, averaging between 1 and 2 grams per ton. Operators are forced to process tens of millions of tons of granite every single year, running complex unit economic calculations every hour, just to ensure that the gold exiting the mill is worth more than the electricity, cyanide, and steel consumed to recover it. That is the cold math that no promoter mentions on Wall Street. Let us assume your 3 million ounce deposit is real. You have the geological drill report sitting in a steel safe, claiming there is $12 billion of metal waiting beneath the dirt. How long before you pull out your first ounce of gold and generate your first dollar of revenue? If your project is located in the United States, securing all necessary environmental, federal, state, and local permits takes between 5 and 8 years. In Canada, permitting historically spans 5 to 7 years. In Australia, if everything goes perfectly without legal challenges, you might pull it off in 3 to 4 years. These timelines are not administrative glitches or government failures. They represent the standard regulatory reality of modern industrial development. During those 5 to 8 years, your revenue is precisely $0. But your capital burn rate is terrifyingly high. You are paying retainers to environmental law firms, hiring specialized engineering groups, funding hydrology studies, assessing local wildlife impacts, and conducting land stability tests. You are negotiating simultaneously with indigenous leadership, local county commissioners, state environmental protection agencies, and federal land management bureaus. Every single month of regulatory delay, while you pay engineering, payroll, and service interest on borrowed capital, is pure cash, leaving your bank account with zero coming back in. And we have not even talked about the initial cost of proving the deposit exists in the first place. Before you can even submit a permit application, you have to drill. Exploration drilling is expensive in a way that shocks investors outside the resource sector. A single core drill hole going 3,000 feet deep through solid hard rock costs between $200 and $400 per meter. If you need 100 core holes to map out your ore body properly, you will easily spend $30 to $60 million on diamond drilling alone, long before lab assay testing or feasibility studies. Across the mining industry, global gold exploration expenditure topped $67 billion over a single 10-year period. The average discovery cost per ounce doubled compared to previous decades, rising past $60 per ounce as shallow. Easy-to-reach deposits were exhausted, and companies were forced to drill thousands of feet deeper. $60 per ounce sounds negligible against a $4,000 spot price, but here is the trap. Most exploration programs find absolutely nothing. You can drop $50 million drilling a promising magnetic anomaly, only to discover after 2 years that the rock grade is too low to justify commercial development. That $50 million is gone forever. There is no insurance policy, no refund, and no asset left to sell. Assume your exploration campaign succeeds, your permits are approved, and you hold a legal charter to build the mine. Now you face the ultimate financial barrier, raising the construction capital. Almost no individual and very few junior mining companies have the cash required to build a modern gold mine from balance sheet reserves. A standard project requires anywhere from $500 million to over $1 billion in upfront capital expenditure. To raise that capital, management must assemble a complex structure of commercial bank loans, public equity offerings, corporate bonds, and specialized financing structures known as streaming agreements. In a streaming deal, capital providers like Franco-Nevada or Wheaton Precious Metals provide hundreds of millions of dollars in upfront construction cash. In exchange, they demand the contractual right to purchase a fixed percentage of your mine's future gold production forever, at a massive discount, sometimes as low as $400 per ounce, regardless of how high spot gold trades in global markets. When you are stranded 5 years away from production and facing bankruptcy, selling a stream looks like a lifesaver, but it creates a permanent drag on your long-term earnings. Every ounce of gold you are contractually forced to deliver to a royalty company at $400 is an ounce. You cannot sell on the spot market at $4,000. Over a 20-year mine life, that early capital structure quietly siphons billions of dollars in free cash flow directly out of your business. Debt financing carries the exact same structural risk. Borrowing $1 billion at a 5% interest rate creates a fixed annual debt service obligation of $50 million before paying back a single dollar of principal. If construction or plant commissioning is delayed by 12 months, which is practically guaranteed in mining engineering, you owe $50 million in cash interest on an asset that is still producing 0 ounces of metal. Many gold mining collapses do not start with poor geology. They start with a brittle balance sheet that cannot survive a simple operational delay. Let us say your financing package is secured. Now you have to build the physical mine. Modern gold construction costs are staggering. Mega projects frequently cost $2 billion, $3 billion, or even $5 billion before extracting their first troy ounce. Consider Barrick Gold's Gold Rush project in Nevada. Even though it sits near existing operational complexes with pre-established regional infrastructure, its underground construction budget sits near $1 billion just to produce 400,000 ounces annually. First, you build access roads. High-grade gold deposits are rarely discovered next to major interstate highways. The easy-to-reach ones were mined during the 19th century gold rushes. Modern mines are built in extreme remote environments. You need heavy haul roads capable of supporting multi-hundred-ton mining trucks carrying massive loads. These are not asphalt country roads. They are engineered rock highways requiring constant grading, dust suppression, and structural maintenance. Next comes electrical power. A modern processing plant consumes as much electricity as a small American city. If the local power grid does not extend into your valley, you must construct your own power utility, installing massive industrial diesel generators, gas turbines, or building high-voltage transmission lines extending dozens of miles through rugged terrain. Then comes industrial water management. Gold processing consumes millions of gallons of water and generates toxic tailings, slimes containing heavy metals, and chemical residue. You must build water treatment facilities, lined retention ponds, and engineered tailings dams. If your mine operates in an arid desert environment, sourcing water costs tens of millions. If you operate in a high-rainfall tropical environment, managing flood risks and preventing toxic runoff costs just as much. Finally, you construct the processing plant itself. This is a massive complex of primary jaw crushers, secondary SAG mills, leaching tanks, and chemical recovery circuits costing hundreds of millions on its own. The grinding mills are particularly capital-intensive. These are giant rotating steel cylinders filled with forged steel balls that tumble continuously, pulverizing solid granite into fine flour. That single grinding process consumes up to 50% of the entire mine's electrical budget. Add on-site housing quarters, commercial kitchens, medical centers, heavy equipment maintenance bays, and a private airfield to fly staff in and out on 2-week shifts. A remote mine is not just an extraction plant, it is a fully functioning, self-contained industrial city that you must build, staff, and maintain from scratch. Once the construction tape is cut and production begins, your capital expenditure converts into permanent, non-negotiable operating expenses. The most visible ongoing drain on your bank account is the mobile equipment fleet. A large open-pit mine operates dozens of ultra-class haul trucks, each capable of carrying up to 400 tons of crushed ore per trip. A single haul truck standing 2 stories tall costs between $3.5 million and $5 million to buy brand new. That purchase price is just your entry ticket. The 6 tires required to run that single truck cost between $40,000 and $75,000 each. Haul roads made of sharp, abrasive, blasted rock chew through heavy rubber at a brutal rate. Under heavy, 24-hour operating conditions, a set of tires may last only a few months. Replacing all 6 tires on a single truck costs up to $450,000. Multiply that across a fleet of 60 trucks, and your tire budget alone exceeds the annual operating cost of a medium-sized manufacturing business. Then comes fuel consumption. A fully loaded ultra-class haul truck burns roughly 30 gallons of diesel fuel every single hour. Running around the clock, one truck consumes nearly 1 million gallons of diesel per year. When global crude oil prices spike and diesel costs surge, your operating expenses jump automatically and unavoidably. You cannot renegotiate your fuel bill with global oil markets. You either pay the prevailing market rate or shut down your haul fleet. Inside the mill, operating costs compound every hour. The steel balls inside your SAG mills wear down into deformed metal scrap and must be replaced continuously. The industrial cyanide used to dissolve gold from crushed rock slurry is consumed with every processing cycle. The activated carbon beds that absorb gold out of the chemical solution degrade and require constant thermal regeneration or replacement. These are not periodic maintenance items. They are continuous, relentless, daily operational expenses that run every hour of the year. The other massive line item on your balance sheet is specialized labor. A modern gold mine requires an army of highly trained specialists, senior economic geologists, mine planning engineers, metallurgists, explosive technicians, heavy equipment, mechanics, environmental compliance officers, and site safety directors. Because mines are located in remote regions, operators must pay premium compensation packages to attract talent. Companies fly workers to site on chartered passenger aircraft for 2-week rotation schedules. When you add up catered food services, private room accommodations, medical staffing, and specialized safety training, labor becomes one of your largest fixed operational costs. In recent years, mining sector wages in North America rose over 8% year over year. When your entire workforce consists of specialized engineers and mechanics, an 8% labor cost increase adds tens of millions of dollars to your annual operating budget without yielding a single extra gram of gold production. Your operational leverage works against you during inflationary cycles. To bring transparency to these compounding operational costs, the World Gold Council introduced a standardized global metric in 2013 called All-in Sustaining Cost, or AISC. AISC aggregates every direct and indirect expense required to mine an ounce of gold sustainably over the long haul. It includes direct mining, crushing, and milling costs. It includes sustaining capital expenditure required to replace aging haul trucks, rebuild worn-out crushers, and raise tailings dam walls. It includes corporate administrative overhead, near-mine exploration required to replace depleted ore reserves, and accounting provisions for ultimate environmental site remediation. In short, AISC represents the true cash cost of staying in business. Average AISC for U.S. gold operations rose to $1,716 per ounce. In Canada, average AISC reached $1,513 per ounce. But those are countrywide averages. The most efficient global producers operating high-grade ore bodies with access to low-cost grid power can achieve an AISC under $1,200 per ounce. Conversely, high-cost, low-grade mines in remote locations routinely push AISC past $1,800 per ounce. At a spot price of $4,000 per ounce, the spread between a Tier 1 asset and a marginal asset looks lucrative. A top-tier mine generates $2,800 in cash margin per ounce, while a struggling mine still collects $2,000 per ounce. Both look fine when gold is trading at historic highs. But drop spot gold back to $1,500 a level, where gold traded for years and the low-grade mine instantly plunges into severe negative cash flow, while the top-tier mine remains solidly profitable. That structural margin compression has erased major mining corporations multiple times over the past 3 decades. Here is the core structural trap at the heart of gold mine economics. Your operating costs are largely fixed, but your top-line revenue is entirely dependent on a volatile commodity price dictated by global macroeconomic forces over which you have zero control. Your equipment debt, labor contracts, power rates, And environmental bonds do not shrink when spot gold drops. But your revenue flexes violently with global market sentiment. Gold traded at $250 per ounce in 1999. It rallied to $1,900 in 2011 before collapsing back below $1,200 for years. It surged past $3,000 in early 2025 and touched historical highs above $5,500 in early 2026. Every point along that historical price curve altered the viability of global mines. An operation that functions as an extraordinary cash machine at $4,000 gold becomes an insolvent liability at $1,200 gold. And a mine cannot simply pause operations during downturns. It must service its debt, maintain environmental compliance, and pay core staff whether it processes ore or sits idle. Look at what unfolded with Newmont and Barrick Gold, the two largest gold producers on Earth. Despite spot gold trading near record highs, both corporate giants suffered sharp stock sell-offs, with Newmont dropping 26% and Barrick falling 19%. The driver was not falling gold prices, it was cost inflation. Newmont projected its AISC to hit $1,680 per ounce due to severe labor shortages and escalating heavy equipment costs. At those cost levels, even with elevated gold prices, profit margins squeezed tighter than Wall Street analysts had modeled. High cost bases combined with debt leverage instantly spook financial markets. As veteran commodity analysts often note, the moment you finish constructing a gold mine, your primary business is no longer mining gold. Your primary business is managing the margin spread between two independent variables: what it costs you to extract a unit of rock versus what global markets decide to pay for it. If you think severe financial failure is limited to small, inexperienced operators, consider two famous industry cautionary tales. In 2015, Rubicon Minerals was developing what appeared to be one of Canada's most promising high-grade discoveries, the Phoenix deposit in Red Lake, Ontario. On paper, drill reports indicated over 3 million ounces of gold reserves. The company raised hundreds of millions of dollars, constructed a state-of-the-art mill, and sank an underground shaft. But when underground mining commenced, workers discovered the gold was not where the geological computer models predicted. The initial surface exploration drill holes had been angled parallel to the actual underground gold structures, leading geologists to systematically overestimate the continuity of the ore deposit. Instead of wide, continuous, mineable veins, the gold existed in narrow, disconnected pockets. Rubicon released a revised resource estimate that slashed its proven reserves by 88%. Nearly 9 out of every 10 ounces investors believed existed on paper vanished overnight. Operations were suspended, hundreds of workers were laid off, and the company filed for creditor protection, wiping out shareholder equity. The gold was real, the plant was built, yet the company still failed. An even larger failure occurred at Barrick Gold's massive Pascua Lama project, straddling the high mountain border between Chile and Argentina. The deposit was gargantuan, holding 18 million ounces of gold and 731 million ounces of silver. Initial construction costs were budgeted at $3 billion. But by the time construction was suspended, capital costs had ballooned past $8 billion, driven by severe environmental violations, regulatory fines, and a tax dispute between Chile and Argentina over royalty splitting. Barrick was forced to take a $5.1 billion write-down on a single project in a single quarter. The largest gold mining company in the world, backed by elite engineering teams and unlimited Wall Street capital, lost over $5 billion trying to develop one of the largest gold deposits ever mapped. That is the nature of this industry. There is another massive expense that almost nobody factors into their financial models when dreaming of owning a mine. Every mine eventually runs out of economic ore. Either the high-grade veins are exhausted, or operating costs rise above the market price of gold. And when production stops, you cannot simply lock the gate, fire the staff, and walk away. In modern mining jurisdictions, environmental site remediation is legally binding and unbelievably expensive. Mine closure requires dismantling surface mill infrastructure, reshaping waste rock dumps to prevent slope failure, capping tailings storage facilities with engineered clay layers, and monitoring regional groundwater quality for decades. Depending on the chemical makeup of your waste rock, water treatment obligations can last indefinitely. Look at Canada's infamous giant mine in Yellowknife. When its corporate operator went bankrupt in 1999, without setting aside adequate reclamation funds, the site was abandoned to the federal government. The environmental cleanup budget reached 4.38 billion Canadian dollars. A massive portion of that cost goes toward keeping 237,000 tons of highly toxic arsenic dust permanently frozen in underground chambers to prevent toxic runoff into local water supplies. Permanently frozen not for 10 years, not for 50 years, but forever. That billions-dollar cost burden fell squarely on taxpayers. To prevent repeat disasters, modern mining regulators require companies to post heavy financial reclamation bonds before turning a single shovel of dirt. That capital is locked up in secure escrow accounts and cannot be deployed for operational growth. It sits on your balance sheet as a permanent liability from day one. None of this means that gold mining is inherently a bad business. It means it is a brutally unforgiving, highly complex engineering discipline where the financial rewards for flawless execution are extraordinary. Consider a Tier 1 mine producing 300,000 ounces of gold annually at an all-in sustaining cost of $1,200 per ounce. At a $4,000 spot price, that mine generates $2,800 in cash profit margin per ounce. Multiply that across 300,000 ounces, and the asset generates $840 million in pre-tax operating profit in a single year. An asset like that, with a 20-year mine life, is worth billions. It can pay off corporate debt, fund strategic acquisitions, distribute dividend payouts to shareholders, and build an empire. That is precisely what occurred at Australia's Fosterville mine. Kirkland Lake Gold utilized the free cash flow from that single Tier 1 discovery to transform from a modest producer into a mining giant that eventually merged with Agnico Eagle. One discovery, properly mapped, conservatively leveraged, and efficiently operated, transformed the structural hierarchy of the global mining industry. Now, take that exact same asset and alter just 3 real-world variables. Spot gold falls from $4,000 to $2,000 per ounce. Your AISC rises from $1,200 to $1,600 due to diesel spikes, labor inflation, and equipment overhaul costs. Your profit margin instantly collapses from $2,800 per ounce down to $400 per ounce. Your annual cash flow drops from $840 million to just $120 million. Now add political risk. The host government decides to raise its top-line mining royalty from 2% to 8%. That 6 percentage point royalty hike wipes out $36 million in annual profit. Your cash flow plunges to $84 million, while your debt service obligations, labor contracts, and environmental bonds remain completely unchanged. Political risk is not theoretical. Governments across South America, Africa, and Asia have raised royalties, cancelled permits, restricted exports, or nationalized assets with minimal notice. You cannot move a mine when host country regulators turn hostile. The spread between a good year and a catastrophic year on a single asset can easily exceed $700 million. The gap between a well-managed mine and a poorly managed mine is the difference between building a multi-billion-dollar corporate giant and filing for bankruptcy protection. What separates successful mining operations from failures is not simply the volume of gold sitting in the ground. It is the ore grade that dictates unit economics. It is the regulatory jurisdiction that dictates political stability. It is the capital structure that dictates debt tolerance during downturns. And it is the quality of the geological engineering that ensures the mine built matches the mine planned. The richest gold mine is not the one holding the most metal. It is the one that can extract metal out of solid rock for less money than global markets are willing to pay for it. Everything else, the heavy machinery, the diamond drilling, the chemical processing, the Wall Street debt, the political negotiations is just a brutal, expensive, unforgiving equation designed to make that simple math work. If you can navigate that equation consistently across decades of volatile commodity prices, labor inflation, regulatory friction, and geological surprises, you might become extraordinarily wealthy. But that is a far cry from the easy money people picture when they dream of owning a gold mine. Subscribe to the World Money Desk for more unvarnished financial breakdowns and corporate economics documentaries. Drop your thoughts in the comments below. Would you take the gamble on a high-grade gold deposit, or is Wall Street debt and cost inflation too brutal to handle? Thanks for watching, and we will see you in the next episode.